coming up in this episode.
And I reflected, and that was absolutely the moment I thought there is a gap in the market here, because actually going from having a bright idea to closing your funding round is a ridiculously well-trodden path in the UK. Now, when you come to VC rounds and private equity cash, and when you throw debt into the mix and all of those weird nuances, I agree. It's, make sure you've got a lawyer near you, make sure you've got some good advisors who know the journey, because there are dragons all over the place here. But doing a pre-seed, pre-revenue funding round is ridiculously formulaic.
I find that infuriating. There's so much within what we do, whether it's in the startup ecosystem, the investment space, whatever, where a lot of people seem to feel the need to gatekeep knowledge and things like that, which obviously your platform is pretty much against in a very philosophical sense, right? With the free information you give out.
Where to start? I mean, there are so many injustices, and the problem is some of these are, everybody's been talking about, the amount of investment that goes to female and other underrepresented founders. We know it's 2%. We know it's been a problem for the last 5 years. We know UK BAA's championed it. We know everybody talks about it. I don't know about you, Greg, but I haven't seen anything happen that has shifted the dial there. And I think there are, and it's not, there are genuinely problems out there that are intractable.
Welcome to Founders Unplugged, hosted by Greg McCallum. Long-form, honest conversations with founders and entrepreneurs from around the world.
Hey, it's me, your host, Greg McCallum. I just wanted to really quickly say before we start this episode, a couple of things. So first, in this episode, the very last episode of this season, episode 41, with the wonderful Sam Simpson from FounderCatalyst. I want to say a huge thank you to him, a huge thank you for all of you for watching, and of course, a huge thank you to the 40 other guests that came and made season 2 what it was. So a huge thank you to everyone involved. Couldn't have done it without all of you watching and listening, and the massive amounts of support that you and everyone in the founder and startup community has provided. So that was the first thing. The other thing is to say that this is a slightly different format for this last episode of the season, and it's going to be a format that we are going to be hopefully doing in the future. As you know, these episodes are typically around 2 hours long, with some exceptions, and they generally are a game of 2 halves. In the first hour, I'm going to ask my guests a lot of questions about them and their journey and their business, and in the second, we kind of go off in all different kinds of directions. Usually, not always. Sometimes it's a bit more chaotic than that, but either way, we love it. But here's the thing. What we're going to do on this episode is you're going to be watching this first part, so part 1. It's going to be the 1 hour, the first hour, and then the second part will come out on the Wednesday. So if you're watching and listening to this, it would have come out on the Sunday, and then a couple of days later, or a few days later, then you'll be able to catch the second part. So you can have a bit of a break, and you don't have to worry about maybe absorbing the whole thing all in one sitting. So we're going to be trying it out just for this episode, and then in the next season, which will be starting in July, we're going to be rolling that out a bit more across the board. So hope you enjoy the new format. Let us know in the comments what you think about it, and we appreciate your continued support for this show. It really, really does mean a lot. Enjoy the part 1 of my conversation with Sam Simpson. Thanks.
Yeah, it's great to be here, Greg. And it's lovely we've both got colds at the same time, so I'm sure this episode will be absolutely crammed.
We're practically brothers as a result, really, aren't we?
Yeah, exactly. It'll be full of coughing and spluttering. So, I guess, it's lovely to be here. I'm Sam Simpson. I'm currently CEO and founder of FounderCatalyst. And CEO sounds a daft title when you're a startup, doesn't it? It's always, but I guess somebody needs the title. But yeah, I head up FounderCatalyst, which is a real honor. Actually, it's a real treat to be involved with that as an endeavor. I guess going back by way of history, I'm a reformed technologist. So did a degree in computer science back in the day, and then spent a very conventional career, in an IT company. Found myself surprisingly, along with 2,500 other people, unemployed one day, and then started my own company. Became an entrepreneur there. Became an angel investor, and I'm sure we'll cover on lots of these themes in more detail, but became an angel investor and then realized that the space, it's broken in lots of ways. I don't know. I'm sure we'll get into both of our thoughts on what works and what doesn't in the startup ecosystem. But yeah, noticed that there were lots broken in the ecosystem and thought I'd roll up my sleeves and do something about it. And here we are a few years later.
Fantastic. Can you, for people who don't know what FounderCatalyst is, can you give the sort of well, I would say elevator pitch, but actually it doesn't need to be. It just, can be as long or short as you like. We've got time.
So, we've got plenty of time.
Yeah, exactly.
Yeah, so FounderCatalyst is by far the most cost-effective way of doing a funding round within the UK. And when I say a funding round, I mean selling equity in your business in return for cash that you can then use to grow the business. But by far the most cost-effective way of doing that. We do a few things actually. So we've got a whole bunch of free stuff we give away on our website, and that's ever increasing. And the reason we've got that is, when you're starting out, virtually every founder hasn't got any money, and they certainly don't want to spend it on the basics. So we give things like employment contracts and advisor agreements and cap table modeling tools and term sheets and that kind of stuff that every founder will normally need, but don't begrudge or just can't afford to pay for. That's not even behind an email scraper or whatever. It's just on our free stuff page. Second thing we do is help people get SEIS and EIS Advanced Assurance. I absolutely love the scheme. So when I exited my business, we managed to invest in our own business via EIS, and it saved me genuinely millions in capital gains tax on an exit. So funny enough, I'm a massive fan of the scheme. So I use it routinely as an investor. And in fact, I've got 32 investments. 0 of those are outside of the SEIS and EIS scheme. They're that fundamental in the UK. So we help people get something called Advanced Assurance for SEIS. And that is it really is amazing. It's proof from HMRC that your business is eligible under the SEIS and EIS schemes. It's just an email. It sounds grand, doesn't it? Advanced Assurance. It's just an email, but it's one of the big 5 things you need in order to do a funding round. We do that for free. We've got a 100% success rate over the last 3 years. And we've only ever had 1 failure ever, which I still don't like to talk about. But there you go. That's reality.
You provide that service for free, did you say?
We do when people commit to a funding round. We don't.
Right. Okay.
Yeah. So that's for free. The third thing we do is legal funding round paperwork. I won't labour this point because I could talk for hours on it. But we produce all of the legal documentation from term sheet at the front end through to share certificate at the back end, as well as all of the big complex documents in the middle, like shareholder agreement and articles. We provide those on a SaaS platform. And then the fourth and final thing we do is we make introductions between our customers and potential sources of funding in a very FCA-friendly manner. So we don't make introductions directly to investors because that's a regulated activity that we're not covered for, but we do make introductions between our customers and private equity club and angel networks, SEIS funds, brokers, the crowdfunders, some amazing free platforms. Shout out to people like, Shipshape.vc. I know you've had Daniel on before. Shout out to UKBAA Dealshare and sites like that. And, I'm a massive fan of pointing founders towards those because I think they're, free or cost-effective ways of getting in touch with investors.
Yeah, great.
So those are the four elements of our service. I guess 2 things that make us unique. So firstly, we're commercially unique. Our fee is genuinely £1,500 ex VAT, no monthly fees, no hidden fees, no percentage of your raise. And we had a lovely example a few weeks ago where a customer raised £2.7 million from a single investor. Don't try that at home, kids. That's a real outlier. That's not a normal pre-seed, pre-revenue round.
Must have been a bloody good product.
Yes, I'm under embargo, so I can't tell you much more about that, sure. Unfortunately. But just an amazing and a real outlier of an initial funding round. And our fee for that was £1,500. And actually, that founder saved over £10,000 compared to any other way of doing the funding round. And I guess the second reason we're unique, me and my co-founders are exited founders and angel investors. So when we're supporting people along their journey, they're getting the support of people who have been there and done that. It's amazing. You probably see this all the time, Greg, but there are so many people in this space, they've done a degree in economics and, they think they're Bill Gates, whereas in reality, they've never built anything, exited anything, or indeed invested anything. So they are to experts as I am to an expert heart surgeon.
Right. Yeah. I don't like the term experts, full stop.
No, and I absolutely do not call myself an expert. That is for sure. But I've been around the block enough, and I see, as part of our jobs, we see and support thousands of funding rounds. So it gives us kind of a unique perspective.
It's interesting that you made the comparison as well then to surgeons, because I consider that in any profession, we should take a little bit from the medical field in that they never consider themselves to be experts necessarily in their field. because they're in science, which is ever changing.
Yes.
And it's the same with every field. Like, we need to steal a little bit of that sort of that framework, I think, for the way that we approach life and business, which is just, we know we have experience, but we're still students, right?
Yeah,
still
absolutely. And I think there's a few, the startup ecosystem is always changing. You've got, external changes from changes in legislation. You've had the recent changes to the financial promotion rules that flip-flopped a little bit and had settled down. But that causes, unforeseen consequences to the broader ecosystem. You get, changes in the economic environment where, fundraising compared with, literally 2 years ago, it was the best quarter ever and everybody was dancing, more money raised for early stage startups than ever. And, the last quarter, according to Bohurst, was one of the worst in a decade or whatever, certainly for kind of SEIS level businesses. So I think, even though you can know the technical, I think the external influences really change fundraising in this space, and how you fundraise today should be massively different to how you fundraised 2 years ago.
Absolutely. It's all the stuff that we put on the risk assessments, right? All those external things, political, economic, and etc. We have to keep our fingers on that pulse. But great explanation of FounderCatalyst as well, and a great product. Talk me through that, how you got to this point. You mentioned obviously a bit about your sort of your journey coming up and the few bits you did, but I'm interested to know a bit more. So take us back. That you said, what did you say? You were a techno. What was the term you used a moment ago? A technological apologist. What did you say?
I can't even remember that.
Oh, okay, it was a good phrase though. I liked it. But take me back to then. So what was your journey in leading up towards FounderCatalyst? Beyond, obviously, you mentioned you got into angel investing and so on. But what happened sort of around before that point?
Yeah. So I mean, my first job, I had the same job pretty much for 13, 14 years of my life. Joined as a most junior engineer, worked up to technical director. I delivered, what would be £100 million project as tech director, which was, career changing. And it was 3 years in probably the most challenging environment you can ever work in. So that was full of fun and games. And I learned an awful lot there.
What company was that with?
That was a company called 2E2 that I worked for, who no longer exists. So, that story does not end well. They were a normal private equity-backed buy and build. So they bought, I think it was 13 companies over 15 years or something like that. And they went from, being zero to, I think they were about 450 million when they disappeared overnight in January 2013. Wow. So they borrowed hundreds of millions from the bank and private equity, bought loads of companies, bolted them together with the aim that, you get multiple arbitrage and you get economies of scale and all of that kind of stuff. And it just didn't work out well. They had borrowed lots of their money from banks on loan notes at 15 to 18%. And even though the business was at kind of 400 million revenue and they made just over 10% EBIT, which is pretty good for an IT provider, they made 40 million a year in EBITDA. The problem is that 40 million is before interest. That's what the I in EBIT stands for. So when they just couldn't service the debt, they couldn't pay off the interest fast enough, and they kept running out of money. Because if you're running a private equity backed business, there's a thing that everybody dreads, which is breaching banking covenants, and that is basically you've got a rule book that the bank says you will not do A, B, C, D. A covenant is a promise to do or not to do something. In this case, it's a promise to have a certain amount of money in the bank or repay the interest as it becomes due or whatever it happens to be. And and that business basically it failed. It breached covenants a couple of times, and the results were catastrophic. It was absolutely eye-watering that the bank could withdraw pretty much instantly all of their lending. They basically call in the debt like that because you've breached a covenant, and that gives them the ability to do so. And that resulted in, I would call it a fire sale, but that would make it sound more orderly than the process was. Effectively, they withdrew their money, called in the administrators and threw the keys in. And that resulted in eventually 2,500 people losing their job over a very, very, very quick period. And a business that they could have sold, if it was a more conventional sale, they could have got a couple of 100 million for it, I'm sure, because it was, it was the fifth biggest systems integrator in the UK. The fifth biggest, but nobody had heard of it, which was a vicious irony. But anyway, and eventually I think the bank's got, maybe 30 million in proceeds because the way that the exit, I call it an exit, but the liquidation was handled. And I remember, it's very dear to my heart. It's probably one of the most shocking moments in my life when, thankfully I wasn't on the call, but in the first day of administration, there were 600 people on a conference call. This is before the days of Zoom. So, but there was a conference call, you dialed into it. All 600 people were told, oh, by the way, you're being made redundant today. That's nice. There's no pay for January. This is on the 28th of January, 2013. So everybody's worked for January. January is a really tight month usually anyway, because everybody's, overspent in Christmas and they're relying on the January pay packet. So they were told there's no pay packet today because that's when it was due. There's no pay in lieu of notice. There's no redundancy pay. You're not going to get your expenses, your bonuses, your commission. All of it's basically gone. We've got no money. And that was 600 people on the very first day on the very first conference call. It was, it was eye-watering, the impact of that. So, so that was my first brush with kind of equity funding, which wasn't the most cheery way to be introduced to it. So the very next day, I kind of found myself unemployed. I have my own choice, and certainly not the only one. So I started another IT company virtually the next day with another 3 guys, and that went really well. We grew from 0 to 30 million in about 4 years. We bootstrapped that. So not something I shout about to FounderCatalyst customers, but because our job is to be honest, I don't think our job is to sell funding rounds at all. I think the first part of our job is to educate people on the options. I've got a slide I always talk about debt, grants, bootstrap, and finally equity. And then very, very finally, much further down the line, I talk about VC. But for me, that's the kind of point of last resort rather than the kind of go-to, which I'd love to touch on later, actually, Greg.
I wholeheartedly agree with you on that one as well. I think it's incredible how many people talk about it as the first call to action, which is incredibly insane. But
and a badge of honor, which is just ridiculous. But anyway,
But no, you facilitate the round, the funding side of things if it is the right decision for those founders and for that startup. Yeah.
And for 0.01% of businesses, absolutely, VC is certainly the right answer. But anyway, we'll come back to that, I'm sure. So started my own IT company, 0 to 30 million in 4 years. My co-founders wanted to do a buy and build strategy. So they wanted to take private equity debt and bank debt in order to, make a couple of acquisitions, and, growth organically was always going to slow down in that business. We managed to pick up Sunday Times Tech Track, second fastest growing company in the UK. We managed to pick up Financial Times, 17th fastest growing company in Europe. And that journey always naturally tails off. Even if you keep doing the great things, you're going to slow down because that's just the way of the world. So my co-founders wanted to kind of continue the growth trajectory by buying other businesses. Now, if you were paying attention at the start of the conversation, my first brush with private equity and bank debt didn't end quite so well. I exited the business in September 2017 with a heavy heart. I must say, I really enjoyed the journey. I'd had a brush with kind of a startup in the past, but this was my first proper roll of the dice being an entrepreneur. And very much, I would class myself as an accidental entrepreneur because, as of January the 27th, 2013, I had no intention. I was in the career. I was, moving up in a business. I'd gone from engineer up to tech director. I wasn't a board director, thank God, but my career had a very clear trajectory. And then the very next day, I found myself being an entrepreneur and starting a business, which is an incredible mind shift, to be honest. Yeah, going from one footing to the other. The company that I grew gave me the entrepreneurial spirit, and I think something happens. There's a fundamental change when you understand what it's like to be in control of your own destiny, be your own boss, and get all of the, I've always been ridiculously motivated. So I worked very, very hard for 2E2, the company I work for, and I worked exactly as hard in my own business. But I think there's a sense of freedom you get that you just don't get in, by being an employee. And here we are, and that's, that fire hasn't been extinguished since.
Well, yeah, and I assume that there's the element of risk mitigation with like you say, being in control of your own destiny, having seen a catastrophe like that and thinking, well, I can't put myself in that position again, right? I don't want to put all my eggs in one of those baskets again, right? But it's incredible because I think a lot of people who have considered or thought about working for a startup, they often consider it to be very high risk because of the fact that, well, it's a startup. I mean, it could go under, right? And anytime anyone says that to me, I'm like, any fucking business can go under, right? It might be great on paper. Like you said, 40 million a year, did you say?
Sorry, the business that failed. No, they were at nearly 400 million.
400 million, right?
Yeah.
So it's like
10% EBIT. Like, if that business can fail,
exactly. It's like there is no safety net for any business. You don't know what's going on behind the scenes. Like, the reality is that anything can go wrong, and to not have a new experience or to potentially learn something and potentially have a great experience just because of that, I don't think that's a good enough reason. So if anyone listening has been offered a job in a startup and it looks good, like, don't let that be the reason to put you off. Like, it's I think
those days of jobs for life have absolutely gone. Even in the big, I know people who work for the big corporates, high street names, and or some very, very, even the big tech startups, there's no job for life there. They're they're much more agile than they used to be in terms of their workforce treatment, which you can understand their business rationale for that. But
it's always been the case anyway. I mean, in business in general, like you said at the beginning, everything is always changing. The landscape, the ecosystem is always changing. There's always new innovation, and you may be a truck driver now or a lorry driver now. It's going to be automated in 10 years. Like, it doesn't really matter what it is. The innovation is going to mean continuously you have to upgrade your skill set, and you may be made redundant, and whatever. You just don't know. A business might completely disappear. Like overnight, with the recent OpenAI announcements, like hundreds of AI companies got killed overnight. Like, you just don't know what's going to happen next. So it's an interesting time to be a human and to try and make money. That's for sure.
That is true. And just to kind of, I guess, put a counterpoint to the point you made around timing. I guess in my case, I'm really, really glad the way my career played out the way it did, because I think so my entrepreneurial career started at the age of 38, which feels really late, actually, doesn't it? Actually, it feels really young now because I'm a decade later, but that's a different story. But it feels late to start an entrepreneurial career. But actually, I think I brought in all of that experience from my everything I'd learned to date, my the technical projects I delivered, the project management discipline. When the business collapsed, I ended up as director of project services. I had 250 million pounds worth of projects and 130 direct reports, which I think, when you work with that many people and you work with that many customers and delivering such diverse projects, it teaches you a really broad skill set. I understand my way around a balance sheet and a P&L, and I understand, by very bitter experience, I understand how funding works within businesses and things like that. And you kind of take all of that life experience. I took all of that life experience into my first proper entrepreneurial endeavor. And I think it would have worked out very different if I was, 25 and tried starting a startup. I'm sure I've had more vigor around me due to age, but actually you're not carrying all of that kind of learned experience and the maturity you get kind of later in your career. So for me personally, I'm really glad it worked out the way it did. It was kind of optimal timing, as painful as the process was at the time.
Yeah, I always think back whenever people start talking about sort of the timing of them starting on their entrepreneurial journey, or when they should build their first idea. And so I always think back to Gandalf in Lord of the Rings, talking about the fact that a wizard is never late, or he always arrives exactly when he is meant to. Like, it's a bit of a nerdy reference, but it's like meaning that it's just the time is right when you decide it's right. Like, there's no one can tell you you're right or wrong to start when you do or you don't. But obviously, I think there's some benefit to gaining experience first. Like, it is going to increase your chances of success to a degree, but then of course there is always a bit of a roll of the dice.
Yeah.
So tell me about so you got into, after your exit, you got into angel investing. So we said we would touch on that a bit. I as you know, I do a bit of that myself.
Yeah.
Although I absolutely don't claim to be an expert at all on that. I'm still fairly new to it. But talk me through why you decided to get into that. What sort of attracted you to that? And what was the process for getting involved in that space?
Yeah, it was really interesting. I guess lots of people in this country. I think one of the biggest travesties for the entrepreneurial and startup space is lots of people don't know the kind of benefits of SEIS. They don't know the benefits of angel investing. And they're not all financial. They're supporting other people. It's something to do. It's it's just interesting in its own right. But I think there are lots of people with very big tax bills who could offset that to a massive extent using SEIS and EIS. And fortunately, I did know about it because I invested in my own business via EIS, and therefore I saved a considerable chunk of change by the CGT exemption rule under EIS. So I was very familiar with the scheme, and like I said earlier, it genuinely saved me millions personally. So all of a sudden, I was a massive fan of it. So I'm like, well, I need to keep using this amazing scheme. And honestly, it was a really interesting transition. I remember exiting my IT business in September 2017, and that had been, it was only 4 years. So it was a really quick journey, but actually, it had been such a fundamental part of my life for those 4 years. It had been, you eat, sleep, breathe. You're waking up every morning worrying about payroll or the project or whatever escalation happened overnight. You go to bed. The last thing you will be doing is solve a problem or send an email or whatever. It was genuinely all-consuming in a way that I guess every founder fears. But yeah, that is the reality of growing something to 30 million in 4 years, I'm afraid.
Hi, a friendly reminder to share this episode with your network, like, and subscribe. And if you are feeling really supportive, please consider reviewing the show on the podcast platform of your choice. It all really helps support what we do. Thank you. Now back to the show.
So yeah, and that switched off, genuinely the very next day that switched off, which is in some ways, it was lovely. I took 6 months off and did just fun stuff. I bought some ridiculous cars. I did lots of track days. I did, private flights to Paris with the partners to say thank you for their support and, the neglect they felt over those 4 years because you were so ensconced work. So I did all of those things you would hope somebody did when they, a tour of Michelin-starred restaurants in the UK, all of that kind of stuff, just to detox, really, just to say, right, this is, and reflect and read books and just reflect on what I wanted to do effectively for the rest of my life. And actually, it was a really interesting fork in the road because I was in a really, really fortunate position at the age of, and I'm trying to count back now exactly when it was, but, I was 40-ish. I was just over 40. I was at the point where I could have stopped working. I had an outcome that would allow me to play golf for the rest of my life and have lovely lunches and, do all of those things. And I've clearly chosen not to go down that path. But that was a very clear decision that I had to make at some point. But anyway, the angel investing, I was always intrigued by the space. I knew nothing about it. I'd never been an angel investor before. I'd never actually taken on investment before. So I thought, right, I'm going to learn everything I can about space. I've got I either know everything about a subject or nothing. I've got one of those weird personalities. So, when I was in technology, I learned everything I could about my subject area, and then quickly forgot it as soon as I didn't. Like project management, I did every course. I took every exam. I kind of learn every element of it because I find it fascinating. As soon as you scratch an itch, that's it. And the same has started, honestly, with the kind of entrepreneurial and startup world. I took a cursory glance at angel investing. I joined an amazing group. So it's now retired. It's called Bristol Private Equity Club, which is by far the biggest investment, or was by far the biggest investment group in the Southwest. It's been replaced by another group called Angel Investors Bristol, which I absolutely love. Shout out to John, Pete, and Ben who run that. And I joined that group, and it was a very welcoming group. You just turned up, you saw some pitches, and I kind of learned via osmosis. I'm like, right, how is that person listening to that pitch, and how are they deciding what's important and things like that? And then I guess my completer finisher nature kicked in, and all of a sudden I wanted to understand, everybody's thought process on why they pick an investment. I wanted to understand, and some of it's irrational, right? You like something about it. You can't really put your finger on it. You get a feeling, but there's lots of really rational reasons that that angels invest in a business. So I kind of wanted to get my head around that, and then I wanted to understand much more about the process. So I kind of immersed myself in that as an angel, and then I started spotting the kind of less pleasant sides to the entrepreneurial space. And I'm sure you've seen this as well. You don't have to spend too much here, but the kind of information asymmetry between founders who typically, this is their first rodeo, they don't know how to play the game. And there are some really, really exploitative people in this space. And I mean, scammers that will steal your business, and people that will, they'll take 50% of your company for a $5,000 investment of those. I don't mean the people that, charge more fees than I feel comfortable with. I don't really care about that. I do care about the fundamental scams. But also there are some bad actors on the founder side. I've myself, and I can bring you some war stories on both sides here, but I've seen some ridiculously bad behavior from founders as well, both in my own investments, and I'll bring some of those to life, I'm sure, but also, I see lots and lots of other investments. And that really doesn't sit well. I guess one of my fundamental principles is around fairness and transparency. And when I see anything that doesn't feel fair, I'm like, well, I need to try and do something about that. And ultimately that led to us creating FounderCatalyst. But going back to the angel story, so I joined BPEC, Bristol Private Equity Club, and I sat out lots of deals. I went to loads and loads of pitch events. I went to loads of, this is pre-corona when the pitch events were a really big thing. And I met some amazing founders, and then I kind of got the bug. There was one of my early investors, and I very quickly built my own thesis about what I'm looking for. And I've actually written an article just on this. Maybe we can put it in the show notes. But I've got an article on how an investor thinks, and it's really appearing to my brain. I brain dumped everything that I think about looking at a proposition, and kind of drew it into a spider diagram. And obviously every investor is going to have a slightly different version of that spider diagram, but everybody will to some extent think of those individual 8 things that are on the diagram. And then I took the plunge. I bumped into my first investment. I think there's a company called Just Wares, and I met the founder there. I saw her at a pitch event, and she was on stage talking about she makes the most comfortable male underwear ever, and I can attest to that. I've got lots of pair of their underwear, and now their t-shirts. They're just amazing. And this is back in 2018, I think, so early 2018. And I saw the founder presenter on stage, and she was her presentation style was confident, quirky, amusing. She was a very small Chinese lady who filled the room with her personality and her presentation technique. And actually, I was a bit in awe of her, because I've never, I've seen quite a few pictures at that point, but the way she held the stage and the complete and utter confidence in her vision. So I took her for a drink afterwards, met her partner, both her co-founder and her life partner, as well, and really warmed to them both, and then ended up investing. So and they're still going. They've the Yang has been on Dragon's Den, and she made a joke about the package size of one of the dragons on there and things like that. So but yeah, it's everything I like about a founder and a business, really. It's got a unique brand, a really really driven founder with bags of personality and credibility. So that was my first investment. And
I thought that was the rule number 1 of investing: never invest in a couple that is also a co-founders.
I didn't understand that. I didn't understand that rule at the point, and
it's complete bullshit.
And I can understand the risk. I mean, there are loads of rules that I don't follow. I mean, and everybody has, and this is a bit of a rabbit.
Rules are made to be broken, right?
Yeah, and everybody. It's quite funny, because I hear founders come to me and say, "Oh my God, I've got problem X and nobody will invest in me." And actually, usually I call that out as nonsense pretty much straight away. And I use this, straightforward explanation. There are, according to Scribe Labs, another great site you should visit. Shout out to those guys. There are, according to Scribe Labs, about 270,000 angels in the UK, give or take. maybe 10 or 20% out, but it doesn't matter. Call it 250,000 angel investors in the UK. And I tell you what, some of those absolutely will not like couples who are co-founders, right? That's okay. So maybe you've lost half of the investors. There are people who don't like solo founders either. There are people who don't like teams of more than two. There are people who don't like B2B. There are people who don't like B2C. There are people who don't like SaaS. There are people who don't like deep tech. There are people who don't like, name any sector, name any facet of a business by which you could select the business, and you will get a percentage who like it and don't. The reality is you are never going to please all 270,000 people, because some people only invest once you're at Series A. Some people only invest, like me, pre-seed, pre-revenue. And there's such a gulf. You just can't please anybody. And founders, you don't need to please all 270,000 people. In a pre-seed, pre-revenue round, you're probably raising 250. You've probably got a pre-money valuation somewhere around the 1.5 million. You need to find 10 people who can commit 25K each. That's it. That's your job, to find 10 people out of 270,000. So and the job is harder. The larger percentage of the 270 you can meet, the chance of you finding those people are easier. But it's just a numbers game. It's just the amount of hustle you're willing to put in. Right. So I don't buy into, now I will caveat that, firstly, if you go to, there are some reasons that some founders just will never get fundraise. And if you let's not deep dive into that, but if we skim over a few examples, you get some founders that are, some ideas that are just uninvestable. They're just, they're just not an investable idea for whatever reason. And that doesn't mean it's a bad idea. You can have a perfectly great lifestyle business. You could make yourself probably a millionaire out of lots of businesses that other people won't invest in. You can have a founder that just can't pitch. And honestly, my natural background isn't sales. I hate everything. I've always avoided everything to do with sales and marketing, yet here we are. But the job of a founder fundamentally is to sell. You're either selling a product or you're selling equity, or both on the same day. Right. The reality is that you are, you need to be really, really good at selling. And if you're not, you need to find somebody who can be a co-founder next to you who can do that. You get some founders that are wedded to ridiculous valuations. So, and I've got the most crazy example that I will spend 2 minutes going on. And then we're going to have to try and walk back up this rabbit hole we're in a minute anyway. But I saw this founder once, and he was raising pre-seed, pre-revenue, no product, raising a 200 million valuation, say. And I kind of he's only raising £70,000 as well. So it's kind of
200 million.
200 million valuation, raising £70,000. Wow. And I kind of said, look, you're raising 0.03% of the, you're diluting by 0.03%, which is a big red flag. The average dilution is 15 to 20%, and you're, orders of magnitude less than that. And also pre-seed, pre-revenue, according to Boher, shout out to those guys too, because they're great. The average pre-money valuation for pre-seed, pre-revenue is 1.5 million. So you are just an outlier. And the guy sent me a valuation report from his accountant, and the accountant should be fired for malpractice, to be honest. And it showed that they did 3 different valuation methods. They did Berkson scorecard that came to about 1.3 or 1.5 million. And then they did, it was either DCF or VC. I'm pretty sure it was the VC method that came up with a valuation of $250 million, 250 million. And what's amazing, the accountant didn't say, I think the 250 might be a bit bonkers and delete it. They did a weighted average of the 3. So they did a 40-40-20 split, giving it out, because the figures were just so different, even though there was only a 20% weighting to the 250 million, the average of the 3, the weighted average, still came to 200 million. And the accountant thought that was a good output from his valuation exercise. Wow. Needless to say that, that business will not get funded. But to walk just up one level for a second on that kind of rabbit hole we're in, if you have prepared for a funding round, and what I mean prepared, you've got a pitch deck, a forecast, you've got a term sheet, your valuation, you've got your SEIS Advanced Assurance. So you've got the 5 basics in place there. If you can articulate your vision in a passionate way that people can understand, if everything is sane about your business, so, no crazy valuation, no tiny market and all of those kind of things, you'll get funded. One way or another, you'll get funded. You may need to change your valuation. You may need to drop your raise amount from, I don't know, 500,000 to 250, and then do another raise shortly after in order to get some traction between the funding rounds. But And I see it demonstrated all the time. I say I believe, but I see it demonstrated all the time. People who do the right things and have, the appetite to speak to investors day in, day out, they get funded.
Yeah, tenacity and determination. You've said so many things in the last sort of 10 minutes or 20 minutes or so that have really resonated with me. Taking a step back to some of the things you were saying about you seeing, I'm paraphrasing you now, but seeing basically the injustices essentially around you and feeling the desire to need to do something about that really resonates with me. I mean, that's very, very much the reason why I do what I do as the no bullshit advisor, like that, and sort of being labeled that. I've just embraced that moniker that was kind of handed to me fully recently, but because I absolutely agree with you. The predatory. I even did a post on this recently on LinkedIn, that the sort of the predators that are out there, the people on both sides that are there to shaft people, especially. Especially, I don't know why founders particularly. I'm hearing so many stories. I've encountered some recently. I'm currently putting together an angel syndicate, and I'm speaking to a lot of angels at the moment. And wow, let's just leave it at that. And so, yeah, that really, really resonated with me. And then what you were saying, especially around, the fact that there are, what you said, like, 250,000 potential investors out there, and it's just about absolutely going for it. That it will happen. It is a numbers game, as cliche as that sounds. That is the case, and as long as you've got your ducks in a row, it will happen. You can't, like you say, like if someone just says, "Oh, I don't invest in solo founders," think, "Oh, well, I'm going to have to go and find a co-founder." Then it's like, no, like stick to your guns. Like, it's your business. Do it how you want to do it, as long as you're doing it right to a degree. Like, there are a few things that some fundamentals, like you say, that do need to be done correctly. Do what you want, and there will be people out there. And I'm forever telling people that. It's like, it's your business, it's your dream. Do what you want to fucking do. Like, don't throw the baby out with the bathwater, kind of thing. So a lot of what you said there really, really resonates, and I feel like we've got a very similar philosophy, especially around calling out injustice and wanting to do something about it, and especially not the gatekeeping of knowledge. I find that infuriating. There's so much within what we do, whether it's in the startup ecosystem, the investment space, whatever, where a lot of people seem to feel the need to gatekeep knowledge and things like that, which obviously your platform is pretty much against in a very philosophical sense, right? With the free information you give out.
Yeah, and great. That's really, really important. I think there's also there's also a general a theme in the startup system where gatekeeping is a great way of explaining it, but lots of founders come in thinking that fundraising is this massive complex thing,
right?
It's really, really hard to do, and there are so many unwritten rules and and that's one of the reasons I started FounderCatalyst. That let me give you an example. I went to a pitch event. I'm going to name and shame. No, I'm not. Yes, I am. I went to a pitch event and I saw just the most amazing founder of one of my businesses. So this guy, Tristan, has, he is investor bingo in one person. He has a PhD in AI. He was a part-time lecturer in UCL. He was a hedge fund trader. He had developed some software in his spare time to do commodities forecasting using AI. And he had a team ready to go. And this is going back before AI was this trendy. It was 4 years ago, say. I'm making that up. So I bumped into Tristan at a pitch event, and I heard him pitch. And I genuinely think I gave him a black eye by throwing my checkbook at the stage when he'd finished. And I'm like, just take my money. How do I invest? And I took him for a beer afterwards and said, really intrigued. I kind of quizzed how he'd tested his model over, previous data sets, all of that kind of stuff, and what he wanted to raise. And I said, great, well, can you send me a term sheet? And have you got SEIS Advanced Assurance? And where are you with valuation? So very standard investor 101 questions. And this was fairly early on in my investing journey, to be honest. And he said, look, I'm going to stop you there. I've got no idea what you're on about. I don't understand any word you've just used, and I don't really know what I'm doing. So I rolled up my sleeves. I helped that company achieve funding. So I got them advanced assurance, got them, their legal paperwork in place, made some intros to investors, and they took on the funding. I mean, it's a real beautiful success case. They took on just $250,000 in initial funding, closed that funding round, They built the team as they promised. They, productized the product. They already had something built, but it was, written in some Python code that needed some industrializing, let's say. And they took it to their pilot customers. They had General Motors, Britvic and Shell as their trial customers who weren't paying, but wow, what logos to pick up on day one. And then 6 months later, they closed a £1 million funding round at, I think, a 6 times valuation in 6 months. And I reflected, and that was absolutely the moment I thought there is a gap in the market here, because actually going from having a bright idea to closing your funding round is a ridiculously well-trodden path in the UK. Now, when you come to VC rounds and private equity cash, and when you throw debt into the mix and all of those weird nuances, I agree. It's, make sure you've got a lawyer near you, make sure you've got some good advisors who know the journey, because there are dragons all over the place here. But doing a pre-seed, pre-revenue funding round is ridiculously formulaic. It's such a well-trodden path. And, you need to incorporate, you need to register at the ITO, you need to get insurances, you need to you close your funding round, and then, you're kind of on your own on the rest of the journey. So my idea from FounderCatalyst came about, it started with me documenting how do you go from bright idea, through to closing your first funding round. I documented that and said, and where do I think I can help out in the ecosystem? And the obvious points were, I don't want to help with all incorporation. You can do it for 10 quid and, it's commoditized. I'm not going to add any value to that. That is straightforward. I think where I can add value is helping with the SEIS and EIS process, because the existing solutions were and still are expensive, clunky, and by the way, they've got a much worse success rate than us. So I thought I would help out there, because I genuinely think we could, and we have, and we do. And then the legal funding round paperwork. But more than that, it's about providing the guidance and support to know what that journey is. So it's shining a light on this journey and say, this is your path to walk along. And if you deviate, then bad things can happen. And it's things like, we've got articles on, I always call my articles emotive things, but, RASA is the devil's work. I explain why an advanced subscription agreement is really, really a bad thing for an investor. And that's based upon me being burnt a few times and other investors I know being burnt. But also, what a toxic term sheet is. How do you spot what normal looks like? What's a good term sheet and what's a bad term sheet? And one of the misconceptions I had at the start of this journey is SEIS is a great leveler, because there are a set of rules within SEIS that mean they kind of clamp down on the terms that your investors are allowed to ask for. So as an angel investor, if I want things like liquidation preferences or anti-dilution or non-dilution rights in a business, I can either have those, or I can have the amazing tax benefits of SEIS and EIS. As an investor, I always pick the tax benefits. So I always thought that actually SEIS and EIS were, all term sheets were very formulaic and similar. But actually, the more you get into the ecosystem, you see, and it's specifically, I'm going to call out SEIS funds here. There are some good SEIS funds, but some of the SEIS funds are just predatory in their term sheets. They are ridiculous fees. They're using something called a liquidation priority that gives them the equivalent of a liquidation preference by any other name. They've got, it's just a completely unbalanced term sheet that is totally different from the rest of the startup ecosystem. So yeah, my motivation for starting FounderCatalyst was to solve some point problems along that journey, but also tell people what the journey is. Be really clear. You are here, you're going here. These are the 10 things you need to do. And I'm not passionate about, and therefore I don't talk a lot about, your go-to-market strategy and how you build a product and things like that. I genuinely.
That's my thing.
Yeah, you're passionate about that. I don't. It's not what I'm passionate about. I care about the mechanisms of safely getting founders from the point there to fully funded, so that they can achieve their dream.
But it's interesting because I take your exact philosophy and apply it to that, right? Which is, it isn't that complicated, really. Like there are certain things that you do have to do in that journey, and you have to nail in order to be successful. Everything else is are the finer details that relate specifically to you and your circumstances, your personality, your products, and so on. And you can that's jazz. You can improvise that stuff, but there are some bass chords that need to be played. right? There is a tempo that needs to be hit. There are some things that just can't be messed with, but they are not as complicated as people make them out. And I suppose it's a bit of a double-edged sword for people like us in their ecosystem, because especially from a content perspective, in terms of wanting to not be the gatekeeper of knowledge and wanting to give it out, it's double-edged in the sense that in some ways we are adding to the noise that can be actually overwhelming for founders who are looking at it, and so we have to be very careful, I think, as our responsibility on how we construct that information, but also I think it kind of comes down, part of my philosophy too on this is it's one thing to kind of sit there and think, because let's be honest, it's an incredibly time-consuming thing, fundraising. Right. And, if you're building a product and you're trying to get traction or get your first, your beta users, whatever, it's not always the best thing to do, because it's naturally going to distract you from building your business. And you need to very carefully consider the timing of that, because it is it's a full-time job. Right. Yeah. You are a fundraiser during that time. You are not the CEO, right, or the founder. And so what a lot of people, I think, struggle with is, like you said, like that founder you spoke to and had that beer with, it's like, I feel like he did the right approach in a way, which was, I don't need to know about it until I need to know about it. Like, it's maybe not necessarily a good idea to say, okay, I'm going to take 6 months out of my life to learn everything about this thing, if ultimately it's not needed at that moment of time. Like, there is no magic formula to this, obviously, but like, it may be, but you've got to be very careful, I think, about when you decide to deep dive. And why I love what you're doing is you're essentially, in some degree, saying, well, once you're ready, that's when we can give you all the information, but don't get too bogged down until then, right? To a degree, if that makes sense. I'm not sure if that.
No, it makes absolute sense. And I think there's a kind of sub point to that, which is, the whole of fundraising. I alluded to this earlier. The whole of fundraising is massive. It's it's a beast, and founders don't know the bits they need to know and not. So founders will get themselves right. What do I need to understand about private equity? What do I need to understand about VC?
And then you just go off on these rabbit holes.
And debt instruments and mezzanine finance and personal guarantees, and how do I understand the grants, and how do I understand, just understanding the equity part of that is massive, because it's huge. But founders don't need to know that. In a pre-seed, pre-revenue funding round, you need to understand what the SEIS, literally, you need to understand a small, tiny chunk of that. You need to understand how the game is played at an SEIS level, because actually everything you learn at that stage, by the time you get to VC, gets thrown away anyway. The game fundamentally changes as soon as you open the door to VC. And in some ways, for the better, you can genuinely raise billions at VC level, which is good, but you don't need to learn about that. And at the point you're raising, even just tens of millions from a VC, you're going to have amazing lawyers sitting next to you. You are going to pay somebody from one of the big law firms that I absolutely would, by the way. You would be paying a law firm to sit next to you to tell you how to play the game and what every turn means and how to de-risk. But it's a totally different game at pre-seed, pre-revenue. And therefore, you don't need to learn this huge thing. You need to learn, what is this part of the journey I'm on here? Right. And hopefully that's what we shine a light on, is you are here, you need to go here. Don't worry about everything else. The rest is noise.
I think a lot of founders as well, and I know a lot of founders, they've told me that they're scared of looking stupid.
Yeah.
And what I think is a really important thing to kind of come to terms with, and I tell founders this all the time, is if you're in a pitch with an angel and you don't know everything about angel investing and fundraising.
If you are enjoying this episode and want to support the show, please subscribe with notifications turned on, and let us know your thoughts and opinions in the comments below. This lets YouTube know we are doing something right. Back to the show.
It's okay. They're not really going to care as much as you care. And again, going back to your example of this guy just going, I have no idea what you're talking about, is a great example of how little investors actually care. And if they do, they're probably not an investor you want on your cap table anyway, because that isn't what you want your founders to be experts in. You should be the expert in angel investing. They should be the expert in what they're doing, right? And if they're good enough to invest in, you'll happily teach them. But I think there's something about sort of almost highly investable about a founder that's willing to put their hand up and go, I don't understand that. Could you explain it? Or I'll be more than happy to go off and learn about that. Like, That's a highly investable trait to be like, I don't know. You know,
I think that is true. There is a line that gets crossed there. So to give you just a ridiculous example, somebody contacted me on LinkedIn a few days ago, and I do. I don't turn people away when they contact me on LinkedIn and say, "Do you want to see my pitch?" I'm like, "Yeah, absolutely." And they offered me a Zoom call. I said, "Would you mind just sending your pitch deck first, just so I can get a view of it?" Sure. And they went, "Oh, I don't have one of those yet." At which point I'm like, "Yeah, I don't think you're quite
right."
ready. Yeah,
some fundamentals, like you said, maybe having those 5 things, which would show just doing some basic research, of course. But then, like, I think when it comes to the bigger terms and all this kind of stuff, all right. It's like I haven't learned that yet. All right, fine. But you've got a good pitch. You're a good individual. You're likable. You've got charisma. You know how to sell your vision. Your product's pretty good. I can see that it's got a good market. I'm willing to either give you the time to go off and learn that stuff, or do you know what? Let's hang around for another 10 minutes. I'll explain it to you. Like, why not? I didn't expect you coming into this to be an expert. No. And I think, if you go to a VC though, slightly different.
Yes. By the time you get to VC, most people have learned to play the game, and they'll understand, what's a preemption right, what's drag along. They'll understand all the basic terms, and they can hold their own.
And like you said, you probably got a bunch of solicitors sat with you.
Yeah, you want a solicitor next to you for sure.
Yeah. It's interesting. I think people put far too much pressure on themselves. Is kind of my point there as well. Yeah, but just to switch gears slightly, from a high net worth individual standpoint. So I mean, you were saying that sort of around that time in your life, you by the sounds of it, you were finally kind of in sort of I guess enjoying the fruits of your labor, right? Which is something I think a lot of people forget to do, to be quite frank. And so fair play to you, right? And then your eye turns to something that interested you and you went for it. But I know a lot of high net worth individuals who have got a similar point in their life, and are they're kind of looking for they may have invested in more traditional means, but they are quite interested in the tech space or the startup ecosystem, but have no idea where to begin, or even what. Just no idea what resources to look at. So if only sort of the opposite side, right? From going to founders who are jumping into something for the first time and not knowing where to start. What sort of advice or tips would you give for those individuals who maybe want to start? Because like you said, there are some benefits there too. So what are those benefits, and what are some things that maybe they could start doing to look into that side of things as maybe becoming an angel investor?
Yeah, and thankfully there's lots more resources. When I started angel investing 6-7 years ago, it was very hard. There are some decent books. You can buy some UK specific books. I think the UK ecosystem is different enough from anywhere else that you should be reading UK stuff rather than how to invest in Silicon Valley, because that's that's a totally different game, different instruments, different valuation, different ethos and methodology, and it's just all different. Within the UK, there's something I love supporting. So there's a lovely chap called Andy Ahim who has Open Angel, which is a spin out of or part of Angel Investment School. And that teaches, they've had a mission for many years to teach angels how to be angels, and with a focus on underrepresented angels as well, which is something I hold very dear to my heart. Andy has very recently started Open Angel and launched that. And that is a whole bunch of resources, mainly in video content, but there's lots of text-based stuff. So it's really accessible, where you can watch, 10, 15 videos, and you can understand how you find deals, how you sift the deals, how you decide which ones are for you, how you deal with a founder, what the legals look like, what the tax incentives look like, what are the mechanics for investing, what do you do post-investment, all of those kind of the journey from spotting an opportunity through to that kind of honeymoon period and hopefully onwards when you're kind of, you've got that long-term relationship with a founder once you invest. So I'm a massive supporter of that. There's a couple of videos from me on there supporting Andy. Please go and check that out if you're thinking of becoming an angel. We've got actually an article on our site, which is it's a long article. It's our dumping ground for everything we think you need to know to be an angel. And it talks about how I think as an angel. So how do I select deals? It talks you through what the tax breaks are for you as a founder. It talks you through, this is all written content, and some people prefer written, some people video. It's the best thing that I ever did, and I would do exactly the same again. I joined a private equity club. I joined a few actually, but I've sat on Angel Investors Bristol being, by far my favorite. I joined one of those, and you surround yourself by people who are on the same journey as you, but they've made 20 investments and you haven't. And then there's the normal standard tips. If I'm talking to investors out there, angel investing is a very illiquid asset class. So once you put your money in, it's not like, buying an ETF in silver and flogging it the next day. Once you put your money in, you're usually in for 7 to 10 years. It's very high risk compared with other asset classes. And you should diversify, right? Within both your broader portfolio, but also within your angel investment portfolio. So imagine you had £100,000 to invest. If you put it all into angel investing, then you're a bit bonkers. You should put some of that in, some in equities and some in commodities and some in bonds and some in high interest, whatever. And then you put maybe 10 or 20% of that, depending on your risk appetite, into angel investing, with the knowledge that you're never going to be able to get it out. You're never going to be able to phone the founder up and say, God, I'm getting a divorce. Can I have my 10 grand back? Because that's not going to happen. And then within the asset class, so within angel investing asset class, if you think I'm going to invest, say, £100,000 over the next 5 years in angel investing, don't put all 100 grand on one horse to start with in the first 5 minutes. A, because you won't really know how to play the game, and that will be a mistake. But B, you want to diversify your portfolio within angel investing as well. So if I look at my own portfolio, I've got some physical products. I've got, the underpants. Just Wear's the underpants people. I've got a few physical products. I've got the middle ground, which I think is AI-enabled companies. And these are all before AI was trending. So in the last 2 years, I've not made a single AI investment because I think it's too frothy. The sector's just bonkers, frankly. It will calm down at some point. But I've got lots of investments in companies like Rovco that do underwater. It's an underwater submersible that uses AI to navigate. It's got a 3D camera that goes around wind farms and oil rigs, and it notices when there's rust or shearing bolts or whatever. So you don't need to send teams of divers down. They've got this, RoboCop type thing swimming around your underwater structures using AI to detect problems. So I've got an investment in that. I've got Skin Analytics, one of my favorite investments, which uses AI to detect melanoma. So you take a picture of a mole, and it's much, much better than a dermatologist. So that's such a really lovely investment. I'm so proud of lots of my investments, actually. And then you've got the other stuff, maybe you've got some B2B SaaS, and then invest in the stuff you enjoy and the founders you enjoy and stuff like that. But don't put all of your money in, certainly nothing niche, and certainly just not all in B2B, not all in fintech, not all in, it's good to have a broad portfolio. But that's what I do. When I started investing, the best thing I did was join a private equity club, for sure.
And for those who don't know what a private equity club is, or an angel group is, can you explain what those are?
I mean, broadly, they're both the same thing. So they are a collection of angel investors who invest together. They usually invest on their own accord. So they will, between them, Angel Investors Bristol, I think it's got 70 odd members. Those 70 people are always looking out for interesting opportunities, and they're always being approached for interesting opportunities. If anybody spots something, then it goes to a selection committee who decide whether they want to see it. That person gets, that startup gets invited to present. And ultimately it ends in an investment between individuals in the club and the startup itself. So it's a kind of loose coupled, it's not like an SEIS fund where it's a much more organized and regimented thing. It's a loose collection of people who decide usually to invest together. And out of the 70 people, it would be very unlikely that all 70 people invest. Out of the 70, you'll maybe get 10 or 15 or 20 people that invest. So for me, if I can go down another rabbit hole here, Greg.
I love rabbit holes. Go for it.
Yeah, but for me, if I was a founder looking for funding, you've got you've got lots of different options. So at the top left here, you've got bootstrapping. You can do that for a while. You've got friends and family. Maybe you can take 50K from mum and dad if you're really lucky and friends. You've got angel investors, individual angel investors, and I think they're a really, really great source, but they're really hard to find. And actually, you need to speak to a lot of angel investors to close a funding round. So imagine you're raising 250, the average ticket size is, say, 25K being generous. You need to find 10 investors to invest. If you've got a 1 in 10 hit rate, then you need to have spoken to 100 investors in order to close your funding round. And honestly, that's probably very optimistic. It's a numbers game, and it's, you know, it's a distraction, as you said earlier, right? You want to be building your business and closing the funding round rather than spending hours doing it. So yeah, you can go to individual angels. You've then got the private equity club and angel networks, which for me are the optimal. And then you've got crowdfunders, SEIS funds, and then you go into institutional investors, VCP, and things like that. And
this is why I love the platforms like Open ShipShape, where you can refine that search basically. I mean, because it is very much a shot in the dark a lot of the time, and I think that's probably one of the fundamental mistakes a lot of founders make initially, is to kind of just message anyone that has angel in their title. And it's like, if you can in some way get some signals as to what their thesis is, the kinds of things that they typically like investing in, or the kinds of things they talk about online, or indicate that they show an interest in, that puts you at an advantage immediately, to the at least there's a slightly higher chance that they may be interested in your particular project, as opposed to just being completely misaligned straight from the off. Like, we don't invest in AI. What's the point? You know what I mean? Like, it's just, it saves you the time. You can hopefully increase that conversion, that outreach to meeting rate just a little bit, and that can really massively move the needle.
And I think you can genuinely move the dial massively there by, if you, like you say, I love the idea. Firstly, using ShipShape is a no-brainer. It's free. If you haven't used it, go and check it out. But also looking on LinkedIn and looking for, if you're, I don't know, Rovco, if you were the founder of Rovco, they're never going to look for angels again, by the way. But if you're the founder of Rovco, just about to do a funding round, and you're trying to find angels, look for AI submersibles, or look for your keywords. And then when you spot people, don't just send them a generic, great, we've got a submersible, would you like to invest? Craft something and say, saw your really great post, we're in this space, this is what we've done, this is our traction. Craft something for that person, because actually, that's a really high value investor. If you send me something generically on your business, there's a very, very, very small chance it's of interest to me. But if somebody is interested in that space, write them a very personal message, explaining to them as a person, as if you're talking to me, as if you're in an elevator. And I think your hit rate goes from probably 0.1% up to 50% or something ridiculous. Back to the theme though. So of this continuum from bootstrap, family and friends, all the way around to VC, the optimal space, certainly, in pre-seed and seed for me, are those private equity club and angel networks. And that is because it's a time cost trade-off, unfortunately. But that is because you will pitch to hopefully 2 or 3 groups. And if you've got your ducks in a row and everything's sane, then you will probably get funded by those groups. And they will take a fee. So they'll take 5% or a 7% fee usually, which is market standard. Don't get upset by that. But that is, you're trading that off against, you're not having to spend the next 6 months raising whilst you're not working in the business. So for me, that is and it will be different for every founder, that is the sweet spot in that kind of curve. And there are about, I think, roughly 130 groups in the UK. You can find, there's a list of them on UK BAA. And also, if I can put in the show notes, Greg, I've got a list of every private equity club and angel network in the UK that you can find by geography. And what you should do, if you've decided you want to go to a private equity club, is say, which are the most appropriate to me? And there's 2 usual ways of doing that. So firstly, you get some angel groups are sector specific. So there are some related to, Science Angel Syndicate and Green Angel Syndicate, for example. They should be the first place to go to if you're within their remit. But also, people love investing in local businesses. So, if you're in Ipswich, then probably don't apply to Angel Investors Bristol as a first place, because that's, way off back. There's a group more locally. If you're in Brighton, you've got 2 great groups there you could apply to. So go local, go sector specific, and then you can broaden your search if they don't work out.
That's good advice. Start local. I think a lot of people go far too big, far too quick. And again, going back to what I'm saying about Open VC, just being too broad and then realizing they have to refine later. And it's like, start with the refining process first, take a bit of time, do a bit of planning, and then broaden it as and when you need to. I think that's a really important lesson that most people learn the hard way, but it's good advice. Just really quickly to dip back into what we were talking about previously as well. from the perspective of maybe high net worths looking into this from the outside, I think it's worth pointing out as well, just before I ask you this, or ask your perception, perspective on this, that the predatory nature that we see for founders is equal, if not even more so, on the angel and investor side as well. In that, especially for those getting started, right?
For sure.
There are a lot of people obviously going to take advantage of people with money looking to get into the space, by selling ridiculous courses and very expensive workshops and consultancies and all that kind of stuff. We have to be very, very. There's some genuine ones too, but there's a lot of charlatans out there.
Yeah.
You mentioned about sort of the diversification of within the asset class of angel investing. That, from the people I've spoken to, is what puts people off sometimes. It's the I'm going to have to learn about all these different sort of business types, B2B, SaaS, fintech, martech, medtech. Like, I'm gonna have to learn what looks good, what doesn't. What would you say to people who are in that position? Because it is undoubtedly an important thing to do to diversify your portfolio across various asset classes.
Yeah.
And it's a shame that sort of puts people off. What would you say to maybe mitigate that?
So, yeah, and your natural, the natural place I would go as an investor is to invest in things I already know about.
Right.
The problem is that gives you a concentration in your portfolio of just things you know about. I think, so, if I reflect on my portfolio and how I've diversified, even though I'm staying close to my core strengths. So I'm a technologist by trade. I could write a line of code now, and my CTO is breathing a sigh of relief as I say that. But yeah, I know enough technology to be dangerous, and therefore, if the middle kind of period of my investment before AI went mad is in the AI space. But I'm not investing in AI for the sake of AI. So Skin Analytics is a medtech play. Rovco is I don't even know how but it's got an underwater submersible. It's nowhere near medtech. I've got commodities forecasting using AI. I've got this seam of businesses that I can fundamentally understand how AI is changing the business model, but it's not an AI business really. It's a fundamentally different business that is augmenting AI to make their product better than anything else on the market. So I'm playing to my strengths, but I don't actually understand I don't understand medtech at all. It's absolutely certainly not my comfort zone. But I feel comfortable investing in that because I understand the principles that they're using in order to build their product. Look, what I also would say is the part of the benefit of being in a private equity club, and I'll give you a ridiculous example of this, but part of the benefit of being in a private equity club is that other people around the table will have expertise you don't. And we had one of my investments that I actually ended up making. They approached Bristol Private Equity Club. They have a system which does huge building vibration dampening. So if you build a tower that's like swaying a bit or vibrating, you buy one of their, and it's novel, the guy's got a PhD, he was a professor in vibration dampening. You buy one of their suitcase-sized boxes that stops the building from shaking. It's just amazing, just such an amazing technology. And we saw the guy pitch. And again, he ticks all of the boxes. He'd built a product. He was about to quit being a professor to commercialize it. He had a team ready to go. He had a sane valuation. He had SEIS in place. So we were just about to invest. And then some investor went, I can't get comfortable with this because I don't understand this space. And I don't know, I don't understand the competition. I don't understand what they're solving. I don't understand the market. And he said, I'm out because of that. It was like a Dragon's Den moment. And everybody else went, that's a really good point. I don't think I can invest anyway. So it went from being hero to zero. And then somebody at the back, chap called Neil, I remember, put his hand up and went, oh, I've got a PhD in vibration dampening. Maybe I could do due diligence. And you kind of go, what? That's ridiculous. And he did DD, and he came away going, I've never seen anything like it. It's fundamentally transformative. I've read this guy's, the professor's papers, and it's game changing. It gets I'm going to invest, and I would urge you all to. And then all of a sudden you're going again. And that gave me comfort as well. I would never have invested in that business without that kind of comfort and kind of thumbs up from somebody in the space. And that's yet another benefit of going with an angel network.
Mm-hmm. Yeah, interesting. Very good. Well, look, let's I would like to try something a bit experimental.
Alrighty.
As it's the last episode, right, of this season. And in season 3, sorry, this is going to bore you a little bit, but it's more for the audience's
No, awesome.
But for season 3, we're going to be doing something a little bit different. As you know, these episodes are a couple of hours long typically, and what we're probably going to be doing in season 3 in July is splitting them up into two parts. So first part will get released on one day, and the second part will get released on another. And we're going to try that with this episode. We're not going to release it all in once. We're going to try it. So this part. So I'm going to call this being end of part 1, and then we're going to enter into part 2. And the reason why there's going to be a slight shift in this part 2. You've been very generous telling us about your journey and about angel investing and about FounderCatalyst. Sorry, there's a lot of similar names.
There are.
This is called Founders Unplugged. They all have the word founder in them. So we're going to shift gears a little bit and talk more broadly about stuff. So end of part 1, part 2 will be out in a few days. If anyone's listening, this is just for the recording's benefit. So part 2 starts now. So
thank you for listening and or watching. Subscribe with notifications turned on to get notified when part 2 comes out. While you wait, please join in the conversation in the comments below.